Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we are following out of the BNN Bloomberg newsroom. The Canadian economy grew more than expected in the third quarter. StatsCan says GDP rose at a 2.6% annual rate, fueled by growth in housing and government spending. Despite the rebound, imports declined, the biggest drop since 2022, falling nearly 9%. StatsCan says a decline in household spending also weighed on growth and a slower accumulation in manufacturing inventories. Now, some analysts believe the data makes it even less likely that the Bank of Canada will cut interest rates at its next meeting. Shares of Tilray ran down after the cannabis company announced a 1-for-10 reverse stock split. It will happen December 2nd. Tilray says it will make shares more attractive and will reduce expenditures related to its annual shareholder meeting. It also means up to $1 million U.S. in cost savings a year. TD Bank and First Horizon defeated investor allegations that they misrepresented the approval prospects for a rushed $13.4 billion deal. A New Jersey judge says First Horizon shareholders lacked standing to sue TD for securities fraud over statements about its own regulatory compliance and commitment to acquiring the bank. TD walked away from the deal in 2023 amid regulatory concerns and U.S. money laundering probes, sending First Horizon's stock price down. The Chicago Mercantile Exchange says all group markets are open and trading after an outage earlier in the day that crippled key parts of financial markets. The exchange operator says it was caused by a cooling system malfunction at a data center in Chicago. CME offers futures and options across commodities, interest rates, equity indexes, foreign exchange, and cryptocurrencies. Here's where we are on the markets right now. The TSX Composite set for another record close, a third of the week, up 190 points on the day up to 31,387. Moving to the U.S. markets, a 36-point move up today for the S&P 500, about 0.5%. The Dow Jones gaining 289 points, 0.6%. And the Nasdaq, 151-point gain on the day. It's up 0.7%. Canada managed to avert a technical recession after an unexpected boost in third quarter GDP, primarily driven by a surge in defense spending. Let's welcome Randall Bartlett. He is Deputy Chief Economist at Desjardins. Thanks for joining us today.
Oh, thank you so much for having me.
Let's start with what was expected, which wasn't what we got. What were projections based on?
Well, consensus had anticipated a 0.5% annualized advance in real GDP in the third quarter, and that was in line with where the Bank of Canada was as well. And so the expectation was that Canada would avoid a technical recession, but that growth in the third quarter would be much more muted than it turned out to be.
All right. So government defense spending is a big driver here. Clearly, given the outline in the budget, we expect this to continue.
Yeah, well, the big level shift up in defense spending, and it was pretty uncertain as to what the timing of that was going to be and what the timing of it is going to be going forward. It can be pretty lumpy. A lot of it depends on when the big purchases happen. And certainly if you look at a lot of the more timely fiscal documents that we get, the Federal Fiscal Monitor that comes out every month, there was no indication that we were going to be getting such a large blowout number in defense spending in the third quarter. And so we'll be having some conversations with StatCan and the federal government to try to figure out how we can track this better going forward and get a sense of what's happening in terms of these lumpy numbers in defense spending.
Are you surprised that the money got out the door so quickly?
I am surprised the money got out so quickly, to be honest. Canada has a pretty checkered past in terms of defense spending and procurement more broadly. And so it's good to see that the federal government is acting fast to make this happen. And so certainly I'm surprised. I know a lot of other analysts are too. And so it's good news for the ability of the federal government to proceed moving forward on meeting its ambitious goals.
All right. So, Randall, we imported less. Is it clear of what? I think cars or vehicles was part of that.
Yeah, two of the big things that fell in the quarter were consumption of or imports of cars, and so purchases of cars too, and so that showed up both in the household consumption numbers as well as the import numbers, and also some of the imports of machinery and equipment as well that go into things like offshore oil platforms, which really drove much higher imports in the second quarter than folks had expected, and helped to drive down imports more than is typically the case in the third quarter as well.
All right. We exported a little bit more, but that was a comeback from the deficit of the last quarter. So do you see trade as stabilizing it at all?
Yeah, we do. We see that trade is starting to stabilize a little bit. We see that not just in the Canadian numbers, but in the global numbers as well. That, we had a fury of trading activity prior to tariffs coming in place as companies tried to build up exports in anticipation of tariffs coming in, and then subsequently a dearth of global trade as there wasn't the need to meet that same demand because of those built up inventories. Now we're starting to see more of a normalization of trade, and still at in some cases at a lower level if we look at things like Canadian exports of steel to the U.S. But in other types of goods, in particular, we're seeing that more of a normalization in trading activity as well as we get a better sense of which goods have tariffs applied, which don't, and which the U.S. domestic producers are able to meet, domestic demand without having to substitute imports for it.
All right. Big energy exports for Canada. Was that primarily to the U.S.? Is it because we're exporting more to Asia?
Yeah, I mean, it's a little bit of column A, a little bit of column B. We did see a bump up in exports to the U.S. as, again, that trade relationship started to normalize. And also some kind of idiosyncratic things that happened in the second quarter came out in the wash. We had some weather and fire-related issues in terms of unplanned shutdowns of production. So that was certainly part of it. Also, of course, getting a sense of what's happening on the tariff front. Internationally, we're seeing that TMX very gradually continues to fill the capacity that it has. Our expectation is that it should be probably at full capacity by the end of next year, beginning of 2027. And so we'll continue to see ongoing demand, particularly from emerging Asia for Canadian energy. And we're seeing that that's helping to buoy both export activity in Canada from energy, but also keep the spread between what U.S. producers get paid and what Canadian producers get paid smaller than it typically would be.
Okay. Do want to ask you how concerned you are about the drop in household spending in the last quarter as we head into what's a key retail period?
Yeah, I'm not, I don't think one data point's a trend necessarily. We saw that consumer activity was quite strong in the first half of the year. Again, part of that was to get ahead of tariffs. It was also partly to take advantage of things like auto rebates that, eventually were ended. So Canadians really, I think, were trying to make sure that they, bore as little of the tariff burden as they possibly could. We also had counter tariffs in place until the beginning of September, and so that also, I think, had an impact on some of the Q3 numbers for consumption, as Canadians were paying more for goods that they consume on a regular basis. And so we saw those come off September 1st. I think that's going to be a little bit of a tailwind to consumption that we wouldn't have had otherwise, and certainly investment. And so we'll see how this shapes up going into the fourth quarter of the year. But we saw the unemployment rate come down in October from 7.1% to 6.9%. We're not expecting it to move much going forward, but given the weakness that we've seen in the economy, the unemployment rate in the labor market's actually faring better than we would have anticipated.
All right, so we'll end on that positive note. Randall Bartlett is the Deputy Chief Economist at Desjardins. Thanks for joining us on The Close.
Oh, thanks so much for having me.
Coming up next, the TSX could end the day in positive territory again, could hit another record close. We're in that range. We're back in a moment. North American markets in the green to end the week. Remember that the American markets have already stopped trading for the day. Yesterday was American Thanksgiving. They stopped early today. So it's just the TSX we are watching, and it looks like it's going to be another record close for the TSX. Let's go to Rebecca Telsher. She's portfolio manager at New Haven Asset Management, and she joins us to talk about what's been going on. Rebecca, we just spoke with our last guest about the most recent GDP numbers, but can I get your quick take on the growth?
Yeah, I mean, again, strong numbers, but in my opinion, this was a mathematical beat. Seems like exports were a lot lower, and so, if exports minus imports, that impacts GDP, and so lower imports does not make for a strong economy. I think there was a lot of underlying weakness that we saw, weakness in domestic demand. And, also we've seen consistently revisions of previous months lower. So last month, they revised. It was originally for, I believe, September. It was supposed to be positive 0.2%. That was revised down to negative, 0.3%. So again, these are preliminary numbers. They are subject to go down. We continue to see weakness in, whether large companies in Canada are starting to lay off employees, whether it's, the consumer being strapped, they're paying more on their housing, they're paying more for groceries as a result of inflation, paying more as a result to, tariff and trade uncertainty. It just seems, the overall sentiment in Canada with regards to the consumer is quite negative. That being said, the sentiment with the market is telling a completely different story.
Yeah, I was going to ask you, how worried are you about the drop in domestic demand?
So not more worried than I was throughout the entire year. I mean, this is playing out pretty much as expected. I mean, Canadians being as indebted as they are, relative to, let's just say, in the U.S., having our 5-year fixed mortgages reset, unlike in the U.S. where you're granted a 30-year mortgage at the same rate for life. In Canada, we know that these resets are coming. We know that Canadians are more indebted. So it was just a matter of, it wasn't a matter of if, it was a matter of when and how much the impact of greater interest rates were going to impact us. And then there was the second impact of higher prices, first through the pandemic with higher inflation. So we saw that first wave, and now, it looks like we're going into a second wave with, tariffs, counter tariffs, and just uncertainty regarding that as well. So we're seeing an uncertain consumer and an uncertain, business owners, and that combined is, resulting in a slower than expected economy.
Okay, so defense spending helped to boost GDP. You saw that. We had the pipeline announcement yesterday. Do you see bigger opportunities for Canadian energy with the AI build out?
Yeah, so it's interesting, Carney's announcement yesterday with regards to the pipelines. I mean, sure. So, directionally, I would say the announcement was positive. I mean, not to sound, cruel, but anything will be positive relative to the type of, build that we saw in the past 10 years. So, I mean, anything is directionally positive versus what we've experienced. That being said, I think the announcement was more symbolic or political in nature. The interesting thing is we have yet to see a comment from, Enbridge or TC Energy or Pembina or, Southbow, if there is an actual appetite to build. I mean, a lot of these companies have their hands full with other projects, and I'm not sure if they want to kind of get back into that. We saw what happened with TC Energy, 10 years ago when they tried to build Energy East, when they tried to build Keystone XL. That didn't work out for them. We saw what happened, with the government taking over Trans Mountain. I'm not sure the government has the appetite to take over another pipeline as well. Enbridge, is actually really busy doing brownfield work. Like they just announced 2 weeks ago an expansion on their main line. They could do a subsequent expansion again for an additional 250,000 barrels a day. Like I'm not sure they want to be handling a large greenfield project right now. So I think Carney's announcement is great in the sense that he's, signaling to the Alberta government that the federal government is not going to get in the way of a new build, but we have yet to see from the actual pipeline builders whether there is an appetite to take on a large, export pipeline in Canada.
Okay, I've got about a minute left with you. I just want to quickly get to tech. What do you see as investors' ongoing concerns?
With tech, he said?
Yes.
Yeah, I mean, tech, it continues to be really overvalued. And again, you're seeing, different investors saying different things. That's what makes a market. The interesting thing is, there's one of the women I work with, she's in her early 70s and she has the benefit of seeing, different markets throughout the years. And it's interesting being a younger investor. And I always look to, my older peers to see, they have that experience. And she said to me, the last time I've seen valuations this high was, between 2005 and 2007, and then again in the late 1990s to the year 2000. And so that's telling. So, are we in a bubble or not? It's still too early to say. It feels like it, but in terms of valuations, they just don't feel sustainable. And we know that a lot of those high valuations, particularly in the US, are driven by the technology sector. It seems like this AI fad. Yeah. I mean, and you're seeing investors being cautious as well. Is this a bubble? We saw really good earnings with NVIDIA. Stock opened up 5% and then ended up down that day because there is this concern. And even if it isn't a bubble, if these stocks are overvalued, there still is a chance of a correction. Okay. Maybe, not a bubble popping, but at least valuations coming back to reality. Yeah. And there's a far way to go before we start seeing normal valuations in that sector.
Gotta leave it there, Rebecca. Thanks so much for joining us. Appreciate that.
Thank you so much.
Coming up next, another look at that memorandum of understanding between Ottawa and Alberta. Alberta and Ottawa signed a new pipeline deal, but what work still needs to be done before construction can begin? We spoke with Randy Allenberger from BMO Capital Markets about that.
Obviously is for someone or Alberta to submit an application to the Major Projects Office by July 1st. But I think the really big step is getting a private sponsor to step up, a pipeline company that's prepared to build this pipeline and sign up shippers. That's the really big step that has to occur.
Is there interest? Is somebody ready to do that, do you feel?
I think there would be interest under certain conditions. And those certain conditions there's got to be some level of cost certainty. I don't think any private sponsor is going to step up and want to experience what we saw with Trans Mountain, which went from $7 billion to $34 billion. I don't think any private sponsor is going to be prepared to take that risk. So there has to be some level of cost certainty. And I think the first step to achieve that is to really find out why did Trans Mountain go from 7 to 34 billion and understand really what drove that and avoid those same mistakes.
And how do we begin that process, and then how do we convince someone that it won't happen again?
Well, there is a review underway right now of the TMX project and how that happens. So I think that step has begun. Beyond that, I mean, at the end of the day, it may require some level of backstop guarantee from somebody like the Alberta government in the event there is cost overruns that aren't due to things that are under control of the pipeline companies. So, as I said, there are a lot of things that have to happen. So we're a long ways away from the finish line, but it's a meaningful first step, really, just because it is a positive reset of the relationship between the federal government and the oil and gas industry here in Canada.
And we spoke to the Premier yesterday. It didn't sound like there was any plans for any public money in this. She thought the markets would be interested in this. Do you think it can go forward without any public backing?
Well, again, if we understand what the regulations are and under the conditions under which the pipeline could be built, I think it's possible. We've built lots of pipelines here in Canada before and haven't experienced the same thing that happened with TMX. So if we can build the pipeline under a reasonable set of guidelines and regulations, I think a private company will be prepared to step up. I mean, certainly from the perspective of, do we have enough oil and gas to support an expansion of that magnitude? Absolutely. I mean, there's 3.8 million barrels a day of identified projects, many of which have been already approved by the Alberta provincial government. So the opportunity is there. It's just a question of getting to understand what those really regulations and conditions are under which you'd build a pipeline.
And with the private market, would they rather see almost zero government and less government better for this project?
Well, I mean, absolutely. I mean, I think less government, involvement and regulation, I think is the preferred path forward here. But again, you really do need to understand what are the conditions under which you can build this thing. What are the sorts of review processes? What's the exposure to court challenges? All of those things that did bog down the TMX project.
And it does feel like those may be waiting. The tanker, lifting up the tanker ban, finding an Indigenous group to be involved in this. You've got BC. Those all sound like a lot of challenges lay ahead.
I think I think there's certainly a level of Indigenous interest here. So I don't think that that's probably as big a hurdle as you think. I mean, of the, I think, 114 Indigenous bands along the pipeline route, something like 100 of them are actually supportive of the pipeline. And so I think there is certainly probably an appetite for participation by a number of Indigenous bands. So I don't really think that that's as big of an impediment as really understanding what are the conditions under which you can build the pipeline.
Now, we have heard, though, some coastal bands were saying no, that they're not going to change their idea on that. Can they work around those, do you think?
Well, I mean, it's, not really for me to say, sort of, but I mean, certainly, as I said, I mean, there's a very high level of support from Indigenous bands across Western Canada, in Alberta and in British Columbia. It's really just the last group of bands, if you will, at the end of the pipe that are opposed to it. Whether or not you can reach an agreement with that, I mean, I really couldn't say.
Okay. And if we do if everything does come together for this, and it looks like it's going to proceed, what kind of a timeline are we looking at, do you think?
Well, I think, as you heard in the previous segment, I mean, it's possible you'd start construction as early as 2029. I suspect a pipeline of this magnitude would be, a build period of 3 to 5 years. So I don't think you'd see oil flowing realistically in probably the middle of the next decade. And
could the price of oil be a factor on this?
Well, the price of oil is always a factor in these projects. I think the advantage that we have is the oil sands are actually one of the lowest cost sources of supply in the world. So we actually fit very well on the cost curve, if you will. And so, we can survive a much lower oil price than many of our competitors, which just puts us in an advantage position to be able to supply a project like this.
And what about the carbon capture project that's part of this, and the commitment to net zero? What kind of factors could they be, do you think?
The Pathways Group is actually very keen to move forward. I mean, the CEOs involved in that have been meeting weekly for the last couple of years to discuss the Pathways project. So they are ready to go. And they're working through that. They've spent a lot of time and a lot of money already moving the Pathways project forward. But, obviously, as the Premier mentioned, it is a bit of a quid pro quo. The pipeline will go ahead if Pathways goes ahead, and vice versa. So Pathways, again, I don't see that as an impediment. It's really, really tied back to that pipeline.
Randy Ollenberger is Managing Director, Oil and Gas Equity Research at BMO Capital Markets. Up next, the closing bells on Bay Street. Here are the closing bells today, just for the TSX. Movember Canada is ending the day in Toronto. Now, the U.S. markets closed earlier today, 1 p.m., and guess who joined them for that? Nobody but Santa Claus. I guess Thanksgiving is over. They've moved on, so Santa Claus ended the day in New York. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. So the TSX gaining another 186 points to end the day and end the trading week. That's another new record high, 31,382, the third record high in a row for the TSX. As mentioned, the U.S. markets closed earlier today and were off yesterday for American Thanksgiving. But the S&P 500 gained 36 points on the day, so 0.5%. Dow Jones moving up 289 points, 0.6%. And the NASDAQ Composite gaining 151 points, 0.7%. And all that glitters today is silver, actually. Spot silver gaining today, ending at $57.16, $3.56 up, and 6.6% up. Silver up a year, so over the last year, 87%. Let's get to some of the stocks that were brought up by the price of silver today, beginning with Endeavour Silver. It gained 12.7% today, moving up $1.55 to $13.74. Let's get to Aya Gold and Silver. It was also a gainer today. It moved up 12% flat, gaining $2.04, taking it to $19.04. First Majestic is also up on the day. It's up 11.4%, a gain of $2.15. And it's up 145% on the year. Discovery Silver also moving today. It gained almost 10% or 70 cents to 772. And then Pan American Silver, a gainer as well today, 6.7% move, close to $4 up to 63.34. All right, let's get to movers south of the border. Let's go to Bloomberg's equities reporter, Jeff Morgan. He joins us now. Jeff, Intel gained today after an analyst pointed to a possible partnership between Intel and Apple. What could that look like?
Yeah, the move today was quite remarkable, given that it was a bit of speculation from an analyst. This was the top performing stock in the S&P 500. This was the biggest gain for Intel since September, and it added $18 billion worth of market cap for Intel. So what happened? TF International analyst speculated that Intel might, as soon as next year, begin shipping some processors for Apple. And this would be a tier one customer and would make Intel a supplier to Apple, potentially increasing the growth prospects for Intel. Largely positive. Aside from that, there wasn't a lot of news from Intel today, so a really big move. I guess that shows you just how much the street would like to see that partnership go forward if it did. But so far, yes, what we have is a bit of musing from an analyst on whether or not that could happen, and that on its own apparently was enough to set this stock on fire today.
Got it. Okay, let's get to shares of private equity firm Compass Diversified. Moved higher because they may restate financial results. Why?
Yeah, this is a bit of an odd one. Okay, so Compass Diversified moved higher today, 12%, because they are now getting closer to restating their financial statements. Everybody knew they would need to do this over the course at some point this year. This stock is still down 68% this year because they said back in May that they would have to restate their financial statements. Yeah, there you can see the chart. Just an absolute drop-off in May, which is when they found some accounting problems at one of their subsidiary companies, which is called Lugano. They own 60% of that, and there were some accounting irregularities there, apparently. The executives there were dismissed, and the company is now needing to restate, and it says it will restate on December 4th. Not only its 2024 financials, it's 2023 as well, and 2022. Those will be audited, apparently, and restated, and the interim quarterly financials will also be restated, but unaudited at that time. So the stock is up today, partly because investors might finally be getting some answers on some of the questions that they've had over the course of this year since that great big leg down, which, as you can see, is just a cliff there in May for this stock.
Got it. All right, Jeff Morgan, thank you, sir. Have a good weekend.
Thank you.
The price of silver reached a new record today following a chaotic hours-long halt in trading futures on the CME's COMEX exchange. Let's go to Brooke Thackeray, research analyst at Horizons ETF, for more on this. Brooke, let's start with silver having a high, having its moment in the sun. 56.5 is where I last saw it. Can you share more insight on what's been driving this?
Well, first of all, from a broad perspective, what we've seen is, the Fed cutting rates. Perhaps the probability has been increased, just like that's provided a tailwind for gold. We've seen that with silver. Silver's been undervalued relative to gold, and so investors like that. And we saw that breakout to an all-time high for silver, and that's a very positive breakout. So we saw investors pile into it. Now, I got to tell you, with the CME outage, power outage this morning, what we saw was a whole bunch of rumors being passed around that there was shortages of silver, so they shut down the exchange. These are rumors. And the community really, the network is a really tight community for silver, so they really piled in and pushed that stock up. Now, if you remember a couple of years ago, we saw the retail investors do a short squeeze on silver, pushing the price up. And that's a little bit what happened today, I think, with retail investors, because it's a very thinly traded market today. Here we are on a holiday weekend for the U.S., very thinly traded, so the retail investors are moving this around.
Okay, let's get to the big tech story, because I want your take on the separation we're beginning to see. We're seeing NVIDIA definitely not sort of flying as high as it was during parts of the year, but some of the other Mag 7 are getting to new record highs. So what are you noticing here?
Well, if you take a look, I think we're starting to see overall, from a broad perspective, we're seeing some challenges, some questioning of the narrative about NVIDIA, about AI overall, about is it profitable, do we have enough energy, all of those major macro questions. Before there was, hey, we just need more chips and more money and we'll all be fine. There's starting to be some real questioning around that. And even this week, we saw NVIDIA put out a memo they distributed to 60 Wall Street analysts saying that we're not a fraud. We're a good company, basically, because there's been this narrative around this. And then when we saw Google come along and they've launched Gemini here, and brand new Gemini AI, it's supposed to be pretty good. And so that's attracting attention. But that's not the big story. The big story is what they've done with the chips. So they've created their own in-house TMU chips to compete against NVIDIA. They require a lot less power than NVIDIA chips, and they're cheaper. Now, they don't do exactly the same job, and they're really used in training of AI. But this is before we had the narrative, well, it's only NVIDIA or nothing. But now investors are realizing that that's just not the case. There is competition, and we're looking at even Meta talking about, well, they might be using Google chips down the road as well for some of their work. So it's not just about NVIDIA. And I think that's probably what we've seen in November. We've seen Google straight up. That was partly Berkshire Hathaway coming in and buying this as well, and launching Gemini, buying with Google. But we saw Google head straight up and NVIDIA down. So it's like alligator jaws. And I think there might be more of that. At the end of the week here, we did see NVIDIA settle down a bit here. So there may be some stabilization, but I still think there might be some more narrative questioning around NVIDIA. And so we might see some further weakness here.
Are there also concerns arising about having enough energy for the build out for AI?
Absolutely. I mean, I think it was Morgan Stanley that came out and said that, over the next 5 years, we're well short of the energy. We're 20% short of expected energy. And we've seen a couple data centers sitting around waiting for energy hookup because there's not enough energy. In other words, we're starting to see bottlenecks in this whole process. It doesn't matter how many GPUs you make and put out there. If you don't have the energy to run them, it doesn't really matter. And so that's a big, big concern on a go-forward basis, because it takes time to build energy. We keep talking about nuclear, but nuclear takes 10, 15 years to build out. That's not what's needed. We needed a short-term solution. Even natural gas takes time to build that out to match up with the needs for AI, which have been ramping up. So there's a bottleneck, and that's a further questioning, basically, of that narrative.
Where are you landing these days on cut in the U.S., the U.S. Federal Reserve rate cut for next month? And what do you see aligning to your thoughts?
Well, this has been a really interesting situation because, a week and a half ago, the odds of a rate cut were approximately 50%, a coin flip that they were going to cut. And then what we've seen, the market rally this week was largely based upon the expectation that the Federal Reserve will cut. So the odds have increased to 94%. According to the swaps market, that the Federal Reserve will cut on December the 10th. That's a huge move on that. So once it gets past 80% and you're close to the date, it's pretty well a done deal. It's very seldom would you ever see the Federal Reserve go against the market in such a big way in this case. So it's probably we're going to see a rate cut at this point. It'll matter about what the words go around it here. But this is what's been driving the market, just increased expectations of the Federal Reserve cut. At some point, that gets priced in. And I think we're probably pretty close to that. So we might see the market actually, now it's priced in a little bit. It might flatten out a little bit and wait for the narrative after in the press conference and see where they're going from here.
I was going to ask you whether or not you think the cuts will continue into 2026 in the U.S.
Well, within the year, they're expecting 3 cuts. It used to be 4, so it's 3. So what we've seen is this curve distort a little bit. So the immediate cut has been brought forward. There will be a couple more cuts expected next year as well, but they'll be spread out. So even though it's not like we're cutting one time in December, it's not like, okay, next year we're going to cut, and keep going from here. Well, it might depend on who gets the Federal Reserve chairperson's position, of course. There are some different people running for that position that really want to cut aggressively, but right now the market does not expect that to happen.
Brooke Thackeray, got to leave it there, sir. Thank you for your time. Have a good weekend.
Thank you.
So it's Black Friday today, one of the biggest shopping events of the year. But will this year look very different from last year because consumers are in a different position? We'll look at that when we come back. Black Friday is one of the year's biggest shopping events. CTV's Scott Hurst is at the Toronto Eaton Centre with more on how the crowds have been shaping up.
The doors flew open early here at the Eaton Centre in downtown Toronto, giving shoppers as much time as possible to hunt for the deals. And I will say, right when the doors opened at 8 o'clock, there were a handful of shoppers trying to get inside right as the stores opened, trying to find those early bird deals. But from my perspective, the crowd really started to swell early in the afternoon and has continued to pick up with every passing hour. Of course, this is Black Friday, one of the most important shopping days of the year, but as we've seen over the past couple of years, it's not so much a one-day event as we might remember from 10, 15 years ago, where there's so much emphasis on door crasher deals, trying to get people into the stores early and trying to get them to spend at the stores and get those big ticket items off the shelves. So nowadays, according to retail analysts and a mall representative who we spoke to earlier today, it's really turned into a multi-day event, and these deals are expected to last for several days. And of course, as you've noticed online as well, deals have already been out there. Black Friday deals, as they're still dubbed, have already been out there for several days, if not several weeks. And that also comes back to the affordability question. Of course, that is top of mind for so many Canadians, particularly this year, not just overall concerns about affordability and how much they can stretch their budget, but this year in particular, Canadians interested to see how much tariffs might affect the price of some of the consumer items that they're looking for. So affordability is top of mind for so many people, and that is part of the reason why retailers have stretched out their deals for several days, if not several weeks. So it might not be the crazy single-day shopping event that it used to be, the specific one-day Black Friday. It might be a Black Friday weekend here in downtown Toronto at the Eaton Centre, and of course at malls and stores right across the country. You're likely to see deals continue for several weeks, and that is helping shoppers when it comes to affordability. And according to retail analysts who we've spoken to, they've said that they're seeing shoppers trying to spread out their payments over several weeks, if not several months, so that those credit card bills aren't piling up all at once. And so it is still quite busy here, despite the fact that it might not be as busy as it was maybe 10, 15 years ago on this one day in the mall, but you can expect it to be busy for several days as Black Friday is stretched out for several days and several weeks, and Canadians are watching their wallets quite closely, trying to spread out those payments as affordability is top of mind, but even still, the buy Canadian sentiment is still top of mind. So affordability might be the biggest concern, but there are still a lot of shoppers, according to retail analysts, who are doing their best to keep their dollars north of the border. Scott Hurst, CTV News, Toronto.
And we are following retail trends this Black Friday and where there are opportunities for investors in the sector. For more on this, our Bloomberg colleague spoke with TD Cowen senior equity research analyst Oliver Chen.
Levi's is an iconic brand with dominant market share at the premium end of the market. Also, as we think about what's happening now in product execution, it's about classics with a twist. It's about getting great value as well. And denim fits really nicely into these themes. What Levi's is doing specifically is more direct to consumer, basically opening their own stores globally. And consumers are looking for value. It plays quite nicely with quality. As you know, 501s last forever, and you shouldn't wash them either.
We turned to surveillance. Oh, tell me, yeah, I get that lecture at home. We turned to surveillance fashion correspondent Lisa Mateo. Lisa, Brandy Melville is on the Mateo target, isn't it?
Oh, okay. So yesterday I received my daughter's 7-page PowerPoint presentation for her Christmas list. My question to you, Oliver, is are people going to be spending as much as they did last holiday season? That's what I want to know, because I put a budget out there.
Yeah, Lisa, first of all, I want that deck. Please email it to me. Second, we are seeing spending. We're seeing a consumer that does have plenty of anxiety, that's looking for great deals. That being said, the consumer still has money, wants joy. We're forecasting up 2 to 3%. Keep in mind, inflation and pricing will be about 2 to 3%. So your units are flat, and there's a bit of a struggle. On the one hand, consumers want joy and wellness and gifting. On the other hand, they're feeling anxious. So we're watching both, and there's a bunch of cross currents, but don't bet against the U.S. consumer. It's been solid.
Worldwide, Oliver Chen with us, TD Cowen, and we continue. Oliver, are we going to get out charge cards or like the Affirm buy now, pay later kind of thing? How are we going to acquire our Christmas, our holiday 2025?
Well, we're going to be using both. And what's still happening is mobile is in the new mall. So we're seeing increased rates of mobile use, but a bit of everything from buy online, pick up in store to curbside pickup to delivery is being used so much. And then I like the good old fashioned way. It's just thrilling to be in the stores this morning and across the country and earlier this week. So it's all happening. And certainly these new ways of payment and the future of payments is very different for younger customers too.
Oliver Chen on luxury right now. Kevin Gordon is in the French Alps at that hotel Audrey Hepburn was in Charade with Cary Grant. He emails in, Oliver, with a great question. This is Kevin Gordon of Charles Schwab. Bottega Veneta blew it up and is doing better with the British type Louise Trotter. The fashion heads of different luxury brands, they still really matter, don't they?
Yeah, what's happening is lots of change. The creative matters. I'm really creating desire, having new design, and we're seeing a lot of newness at Gucci and others. And Bottega's been doing great. The themes for luxury continue to be quiet luxury in terms of what's happening with less focus on logos and a real emphasis on quality and materials. So Bottega Veneta fits nicely in that trend. As you know, Brunello Cucinelli, Loro Piana. And I'm a personal lover of Gucci, so I want to see them win. We're watching some creative change there at Tom Ford, too.
Right, we've seen that. And Lisa, you mentioned today Burberry, a little bit off the mark. They've been hugely promotional. Lisa Mateo
they have.
with us with Oliver Chen.
Now, also on the luxury segment, I'm going through the Wall Street Journal this morning, and it has this article that says jewelry is outperforming the rest of the luxury world. Are you seeing that?
Yes, we are. We love Cartier. So there's definitely a barbell and bifurcation where more pressure at the low and middle, and then some real strength at the high end. And Cartier Richemont Group is outperforming Van Cleef as well as Cartier. Customers are gravitating towards gold, jewelry, real stores of value, and the prices here are compelling because handbag prices have gotten extreme. So the Love collection at Cartier, Love Unlimited at Cartier, the Maison, really enduring value and timelessness. And overall, the jewelry growth rates have been in the high single digit, and we've been struggling to grow in handbags.
Will we see M&A this year? I mean, in so many other industries, we talk about mergers and acquisitions, and Wall Street's on fire with a boom economy. In the Oliver Chen world, do they gobble up the weak providers in luxury, or frankly in other markets as well?
Yeah, Tom, I think what we'll see is selective M&A. Beauty is always an M&A orientated sector in terms of large players acquiring brands that have been developed by founders. Skincare, longevity, niche fragrances, those are big opportunities. In luxury, it'll be selective. There are some assets that have sold, and we'll see, but the market's getting better with the consumer on more stable footing. So M&A is totally possible, and we're watching the IPO market too.
Oliver Chen, your single best buy, please.
We like Walmart. We like the AI story. We like the value story. We like delivery, curbside pickup, marketplace model, digital advertising. That remains a favorite for us.
Oliver, I got a PE of 43 on Walmart. You got to be kidding me. How is that possible?
There's a lot ahead. Digital advertising for Walmart is in the $5 billion range. Think about Google, Amazon, and others that are 50 plus. Furthermore, their capabilities, it's themes about the big getting bigger and reaching more and more profitability online, in part because of digital advertising as well as the marketplace. In addition, it's defensive in that it's a leading grocery business with 60% of the revenue being grocery. So we're excited about all these things. On the offense, on AI, as well as delivery and micro fulfillment, on the defense, as well as the everyday low price. And that's what consumers are looking for today. Finally, they're getting higher household income consumers as well, and they're serving the middle and low well too with that everyday low price. I grew up in Louisiana going to the Walmart Supercenter, and it's a real community-driven retailer as well.
TD Cowen's Oliver Chen there. Coming up, Liberal MPs insist there are no divisions emerging within after the party loses a cabinet minister. Back in a moment. A former federal environment minister under Justin Trudeau has resigned as cabinet minister of identity and culture under Mark Carney. He resigned on the same day that Carney announced that pipeline agreement with Alberta, which was yesterday. For more on this, let's go to CTV's Jeremy Sharon. He joins us now. Jeremy, do we know much more about this?
Yeah, Marilla, not a lot more other than, clearly this was a line in the sand, a hard line in the sand for Stephen Guilbeault, former environment minister under Justin Trudeau, who decided that this MOU with Alberta was just too far for him when it comes to changing course on some of the climate policies that were adopted when he was environment minister under Trudeau. So things like the oil and gas emissions cap that this government has indicated it is willing to do away with, the carbon price, the consumer carbon tax, something that was reversed early on under the Carney government. Those are two policies that Stephen Guilbeault implemented as environment minister. So this seems to have been, that final straw for him that forced him to make the decision to step away from cabinet.
Okay, Carney has pivoted widely, as you mentioned, away from Justin Trudeau's climate plan. So could this be more of a problem for other members of cabinet or other members of the Liberal caucus?
I think it's certainly something he and his government are going to have to be aware of, and they're going to have to be, pretty focused on caucus and cabinet management when it comes to managing expectations and ensuring that some of those MPs, some of those Trudeau-era ministers, are still on board with the direction this government is going in. Because, as you just touched on, some of the policies that this prime minister has proposed are, a clear change and shift from what the Liberal government under Prime Minister Justin Trudeau were doing. So we're seeing stark differences. And that's a good thing for him when it comes to the electorate, because Canadians, many of which voted for these changes, supported him in making these promises. So they're expecting him to follow through on these promises. But on the flip side, he has to ensure that, all of his ministers are on board and that he's continuing to do the work to ensure that they continue to be supportive of some of these changes to policies that they may be, closely tied to under the former prime minister. So it's a bit of a balancing act that the prime minister is having to deal with here.
Yeah, absolutely, and could be one he has to balance for a long time. Jeremy Sharon joining us today out of Ottawa. Thanks, Jeremy.
Anytime.
The Ukrainian president's chief of staff has resigned hours after anti-corruption agents searched his home. We have more on that story in a moment. Volodymyr Zelensky's chief of staff and closest ally, Andriy Yermak, has resigned after anti-corruption agencies searched his apartment. Now, this happened at a key time when peace negotiations are underway. Let's talk about this with Walter Dorn, professor of defense studies at the Royal Military College and Canadian Forces College. Thanks for joining us today.
Thank you, Marilla. Always good to be with you.
It sounds like Yermak hasn't actually been accused of anything. So was it necessary for him to resign?
We don't yet know because we don't know what they found at his house. But at the same time, we know that it looks bad on the president of Ukraine himself because there's so many members of his cabinet seem to be involved. So this might be that Yermak is taking the hit, and hopefully that would just cause some of the critics to be more silent. But at the same time, we don't know whether he was actually involved in corruption or not.
Okay, so he may have fallen on his sword to deal with the situation. Let's get to the peace plan as outlined to date. Many have said it capitulates to Russia, and I'm wondering if you agree about that.
The original Trump 28-point peace plan was very pro-Russian. It seemed to, well, first of all, it was negotiated with Russia first before it was even given to Ukraine. So that was really surprising, given that Ukraine is the ally, is the country that needs the support. It's the victim. And to have negotiated with Russia first and coming to some terms that Russia could agree with really seemed to be out of place. Then when Ukraine got it, they were kind of shocked. They didn't want to say that they rejected it, but they got their European allies to come up with a counter proposal, and that proposal is much more balanced. It uses a lot of the words of the 28-point peace plan of Trump, but it actually makes a lot of the provisions more Ukraine-friendly.
Okay, for example, what about Donbass? What about Crimea? In the newer proposal, do they go back to Ukraine?
So in the new proposal, the European proposal, the territory would not be recognized as Russian, but the fact that Russia occupies that territory would be recognized. So Ukraine would still have sovereignty in a legal sense, but in the practical sense, it would recognize that Russia is there on one side of the line of contact. And it does specify that they could have swaps of territory along the line of contact for who controls the territory. But the important part is that Ukraine's sovereignty is intact.
But that would be for Donbass. I can't see them agreeing to that for Crimea.
No, Russia would like to see that the territory is annexed and also is recognized as part of Russia. But Ukraine would never agree to that. And so that's going to be a major sticking point as negotiations go forward. However, the fact that this agreement might say de facto, that's the original word used in the U.S. Proposal, the de facto Russian presence in Crimea could be recognized because we know that's the reality. At the same time, you wouldn't want to give up territory. You wouldn't want to say we're giving it to Russia.
What about Ukraine's desire to join NATO, which was one of the triggers of the conflict early on? How does this get considered in a peace plan?
Right. Originally, the original Trump proposal was that Ukraine would not join NATO. And NATO has already said that Ukraine will join NATO. The current proposal says that NATO won't station any forces under its control permanently on Ukrainian territory. But that does allow that there might be some NATO member states who place forces on a temporary basis, put some bases to help guarantee the peace agreement. And then the NATO could accept Ukraine into the future, but that's not specified. And of course, any NATO membership is subject to veto by any of the members of NATO itself. So that might be a long time.
Okay, so do you see this revised version offered by Europe being accepted by Vladimir Putin?
No, but it's a good step forward. And the kind of negotiations are going to, I think, take months because you need to be able to refine the wording. You need to be able to find compromises. But the whole negotiating process is a good start to finding a solution to this war. Because before it would just look like it was going to grind on and consume ever more number of lives. Now at least we have the beginning of a peace process.
So if I'm reading this right, this is not going to be resolved by end of year.
I don't see this being resolved this year. I think they'll go back and forth. Ideally, there would be a ceasefire first, but the 28-point peace plan says the ceasefire comes after agreement, which makes stopping the war much more distant in the future.
All right, Walter Dorn, I'll leave it there with you, sir, but thank you for joining us today. Appreciate that.
Thank you, Merrill.
Coming up, a recap of the big tech stories of the week. We're back in a moment. There was a report this week that Meta was in talks to buy Google's AI chips instead of using NVIDIA chips like many do, and this shook up tech investors. For more, let's go to technology analyst Carmi Levy. He joined us now. Carmi, Google chips versus NVIDIA chips, how do they even compare?
Well, if you listen to NVIDIA, their reaction is they're a generation ahead. No one runs every model everywhere like NVIDIA's technology does. Google, of course, begs to differ. And if it strikes this deal with Meta, it's the first real significant public-facing, really sort of chip in NVIDIA's armor, so to speak. The proof is in the pudding. Once those chips are installed in a data center, then you can benchmark them against each other. But really, it does show that NVIDIA isn't the only game in town, and Google has every intention of taking them on, which is why investors were so skittish in response this week.
Okay, let's also talk about AI and productivity. A report from the Vector Institute finding that it could add nearly $200,000 per job per year to the Canadian economy. What do you think of the numbers? And if you can sort of give us an example maybe of how that would work.
Well, we've been talking about the productivity gap for years, and so this finally puts a dollar figure on how AI as a technology can help Canada potentially close that gap. $200,000 per role per year is nothing to sneeze at. The overall numbers are also huge. They're saying it could pump as much as $52 billion into Ontario's economy over the next 5 years. And so, what it looks like in the day-to-day is if you think of the tasks that an individual worker does over the course of a given workday, AI will automate that, allow them to cover far more ground within a given timeline, which means they can do more and produce more and ultimately generate more revenue for the companies they work for. So multiply that out by a workforce, and you are talking significant economic impact. If Canada can capture that, that goes a long way toward addressing that productivity gain we've been talking about, and also potentially allows us to compete against other countries that are likely thinking the same thing.
Why does Ontario stand to gain the most from this kind of productivity gain from AI?
Because a lot of Canada's AI research and education infrastructure is already located in Ontario. For example, University of Ontario, that's where Dr. Jeffrey Hinton teaches. That's what a lot of the resources and research dollars have been going in recent years. And a lot of, Canada is, tech startup nation. A lot of those AI-based startups are based in Toronto, in the Kitchener-Waterloo Cambridge corridor. So, the fact that the dollar figures tend to follow that should be no surprise. That, of course, presents a bit of a challenge. You want to have geographic diversity across the country. You don't want to have AI haves and AI have-nots any more than you wanted tech haves and have-nots in earlier technology revolutions. So I think this is kind of a message to the government that as you're considering your AI investments across the country, make sure that they are properly distributed so that they don't just go to one region, that those resources are spread rather evenly. That will ultimately ensure that Canada can be more competitive as well.
You've also been watching another story about the rise of lawsuits over, I guess, big tech sort of trying to take information that looks damaging to them and sort of put it under the rug. Tell us about that.
Yeah, exactly. So OpenAI is in court. They're being sued by the parents of a child who ended his life after months of engaging in conversation with ChatGPT, and so a lot of the discovery process, the documents that are being shared now show that the company knew that this was a problem, and yet is still blaming the victim. Companies behaving badly, basically saying this 16-year-old kid who ended his life because of a chatbot violated the terms of use that he signed on for. Therefore, it's not their fault. Meta doing the same thing. There was it was called Project Mercury. It was a study to measure the impact of the use of Facebook on the mental health of those who use the product. And it showed that, there was a negative impact on their mental health. And when they stopped using it, those impacts were reversed. And what did they do with the study? They killed it. They buried it so that no one would see it. It's only coming to light now because of court action. And then another story showing that their oversight board is perfectly fine with leaving AI manipulated content on the platform, despite the fact that it was created in response to earlier scandals that the company wasn't transparent enough stuff. So it seems like a bit of a paper tiger. All these promises to be more, let's call it ethical in how they perform, but that's clearly not the case. It shows that tech companies are, when out of sight of the public, increasingly aggressive to defend their turf, protect their brands, and ensure that their core technologies aren't subject to, let's call it ethical revisions that might compromise their growth, compromise their profitability, compromise the level of engagement with their end users, even if they do cross moral and ethical and in some cases legal lines. It's a troubling place to be. We saw it with social media. We're seeing it now play out with AI tools as well.
And you mentioned, we talked recently about the scam ads, right, all over social media that some are allowing to flourish.
Yeah. Exactly. Investors love this, Morella, of course, because it's what drives revenue. And in the wake of, for example, the Meta news becoming public, the stock went up 9% over the week afterwards. So it shows that the markets like this, even if the rest of us are cringing outwardly saying this is not appropriate behavior. But I guess in the capitalist context, this makes sense in terms of growing your business.
All right, technology analyst Carmi Levy, we leave it at that, sir. Thanks for joining us today. Appreciate the time.
Thanks, Marilla.
Coming up, hot picks in light of Black Friday. We'll look at 3 picks in retail. More in a moment. It is Black Friday, which of course will be followed by Cyber Monday. Today we spoke with David Schwartz, Senior Equity Analyst, Consumer Equity Research at Morningstar, and we talked about 3 standout retail stock deals. We kick things off with Nike.
One day out of the holiday period, and so you don't really want to draw conclusions as far as what the Black Friday sales look like. It's also hard to get good data. There's a lot of anecdotal discussion about shopping mall traffic and things like that, but you never really know if that translates into sales until later. And so people often will jump to conclusions perhaps prematurely.
Let's get to your first idea. Nike, they, of course, are big in China. They've had their troubles, though, in recent years, keeping up with the consumer. Actually, I didn't know that. The stock is down pretty sharply in the past year. You do see potential here, though?
Yeah, I do. Certainly, Nike stock has been down quite a lot. The company really has had 2 difficult years, and that's been reflected in the stock price. But, you know, Nike still has a lot of strengths, including its connection to global sports. The company got a new CEO about a year ago, and he seems to be moving the company in the right direction. They're really focused on putting out quality products, performance products, and perhaps in the past, Nike had gotten away from that a little bit by focusing too much on the actual retail experience and moving away from their wholesale accounts. Nike right now is really trying to improve its relationships with wholesale partners, including the combined Dick's Sporting Goods and Foot Locker. And, you know, I think in the long run, Nike still has the strongest position in this market, and still a favorable market. The sportswear market is very large and global. And, you know, Nike right now, my fair value estimate is $104 a share. And so I think that for people that are willing to wait and see how this works out, I think this is potentially a good time to buy Nike.
Okay. Lululemon, a go-go stock. Maybe we'll put up a 5-year chart that did drop, something of a fallen angel. You see them getting their mojo back?
Yeah, like Nike, Lululemon's had kind of a difficult year, but you have to keep it in perspective that Lululemon's numbers are still really good for most apparel companies. The company generates very high margins. It does mostly direct selling, which is a model that really is very profitable for them. But people have been concerned that Lululemon's growth in North America has slowed. There's also concerns about the China sportswear market, which is a market where Lululemon expects to generate a lot of sales growth. But my fair value estimate on Lululemon is $295 a share. And so I think it's actually quite undervalued right now, which is quite a big change from the past when Lululemon was often very highly valued. And at one time, it traded at a PE of about 50 times. So Lululemon's valuation has certainly contracted considerably, and I think that this is a good opportunity to buy the stock at a good valuation. As a company that has no debt and generates huge amount of cash flow, and so very strong balance sheet as well.
Has the magic gone, though, for Lululemon? I mean, could it be that, sure, they were a cult stock, they did a great job of organizing local yoga groups, but has the gloss gone off the story? And
it is true that the market itself has become more competitive, and we have seen some strong competition in the women's athleisure space. But, you know, I still think that Lululemon has a lot of fans. I don't think that people have really soured on the brand. I think that recently Lululemon has not put out enough new stuff, and that people haven't had a good reason to shop there as that they have in the past. But Lululemon has a lot of new products coming out, and I think that consumers will respond. I still think that Lululemon has a strong following, and that the company really puts out very high quality products.
And then finally, Gildan, a very different story. Obviously, they do sell some stuff under their own brand, but they're a huge supplier of generic garments as well.
Yeah, so right now, Gildan is about to close its acquisition of Hanes Brands, the U.S. Major underwear and basic apparel manufacturer. And so, you know, that's really going to affect Gildan's consumer business. It's going to be a major consumer business now. In the past, and still today, Gildan is mainly known for printwear, which is producing essentially blank shirts for the printwear market. But Lululemon's also going to be a major company now in branded basics. And so, you know, I think this is a transformative acquisition for the company, and people don't necessarily recognize this. And the stock, both in the U.S. and Canada, are trading at very large discounts to my fair value estimates. My valuation in the Canada shares is $128 Canadian. So I think that there's really an opportunity right now to buy Gildan at a good valuation with this acquisition closing, which I think is really being undervalued by the stock market.
Leave us with a final thought. What retail generally, we know there's the relentless march online. What other big trends are you seeing, David?
Well, we are seeing some trends in terms of retailers that cater to lower income consumers, and higher income consumers are doing well, but the middle class is really not doing so well in the United States, especially. And so we're seeing a lot of weakness from department stores and from retailers that cater to the middle class, but we're seeing strength in retailers such as Ralph Lauren, for example, and also Urban Outfitters labels in the U.S. That cater to higher income consumers, but also lower income consumers and middle class consumers are shopping at clearance stores like Ross and TJ Maxx in the U.S. And so we are seeing some changes, and these have really been ongoing for years, but they have continued this year and probably will continue into the future, where retailers that cater to the middle class are continuing to struggle.
David Schwartz, Senior Equity Analyst, Consumer Equity Research at Morningstar. China has invested billions of dollars in building ports around the world, giving Beijing a strategic advantage as trade tensions rise, but also sparking security concerns for the rest of the world. Bloomberg's Lucia, he has more on that.
Every year, China imports about 66,000 metric tons of these. That's the weight of about 6.5 Parisian landmarks, or if you like, 440 blue whales. And most of these avocados come all the way from Peru. This journey used to take over a month. Now it's a straight shot, cutting it by 10 days. Why? One word: megaport. And it's paid for by China.
Chinese President Xi Jinping begins a week-long South America tour, opening a China-funded megaport in Peru.
This is a huge investment, not only for Peru, but in Latin America, and it is expected to triple agricultural exports of Peru.
Over the last 20 years, China has built up a network of about 100 ports on every continent except Antarctica, clustered around key maritime choke points, which are crucial to global trade.
This gives China a strategic advantage as global trade tensions rise. but it's also sparking concerns.
Even though these ports by and large are commercial ports, some of them do actually have the capacity to host naval vessels.
All right, that does it for today's program. Thanks for joining us on The Close. We'll see you back here on Monday.